So welcome again, everybody, and whoever is new here and join us for the first time. We are meeting here every Monday, almost every Monday at 9 p.m. Israel time or 2 p.m. Eastern time to have a conversation about real estate and real estate related subjects. And I'm very happy to have the opportunity to have Mike here with us today. Thank you, Mike, for carving time for us and coming and sharing your knowledge with us. Mike is my mortgage broker in Rochester. He has
insurance broker.
Insurance broker, yeah, insurance broker. Let me clarify that. We're talking about insurance, so it came as my broker. As an insurance broker, is my insurance broker in Rochester. He has over 15 years of experience. He's very knowledgeable. An amazing guys, and I'm gonna clear one second. I'm gonna let you share, by the way, Mike. I need to let you share, and I'm gonna let him give us the opportunity to prepare the presentation for us. And again, let him talk. If you have any questions, again, you can either ask or text or chat, and I'm gonna translate it. But we're going to stop in certain points for questions, and then at the end, if somebody has a specific, and I'm sure everybody or some of you have a very personal related question about your cases in insurance, and if Mike can help, hopefully you're going to be willing to do so. Mike, you ready?
Absolutely.
Great. Share screen. It's all you now.
All right. Are you able to see my screen?
Not yet.
Let's see, share screen.
There we go.
There we go.
Here we go.
All right, let me just get to the other screen I want for this. All right, great. So first of all, again, thank you for the opportunity to talk to you a little bit about insurance and the world of property and casualty insurance in regards to real estate investing and property and liability exposures. As you can see here, this is just the agency that I work for. It's Gerard P. Smith Insurance Agency out of Rochester, New York. As Tal had said, I've been here for 15 years. I've got a mixed bag of kind of what I do, but commercial insurance has always been my focus.
Mike,
yes.
I'll stop you for a second. My suggestion, and just because the crowd, slow down a little bit.
Okay. Absolutely. Yep.
Go.
So no problem. So just to give a little bit of, my experience level with real estate, I currently control about a little bit over $4.5 million worth of insurance premium. But out of that $4.5 million, approximately 35% of it is real estate investment insurance portfolio. So I've been doing this for several years, many years, and a lot of it has to do with the real estate world. I am going to get to the first slide here. Basically every business owner and investor needs to have insurance to protect their asset. One of the mentors in the business from me always used this little theme of premiums are cheap and insurance claims are expensive. And when you really think about it, obviously as an investor, insurance is one of the larger costs. And yes, you want to ultimately try and do it at the lowest premium possible. You want to make sure that you're covered properly, or at least that you're covered in a way that the policy is going to respond the way you expect it to when a claim arises. And the reason why I say that is because insurance is not not every policy is created equal. There are nuances and differences. Anyone that's opened up and read an insurance policy will see it's a long contract. There's a ton of fine print, and it really, it can be quite confusing if not handled properly. One of the questions I'll touch on is, how much and what kind of insurance should I buy? And ultimately, that really depends on the type of property, its size, the exposures inside of that property, and what your risk tolerance is. And, everybody's risk tolerance is different. When I say what kind of property, what type of property is, there's three main categories. One would be strictly commercial use. So that's just a building that's going to occupy a commercial tenant, like a retail store, a manufacturer, wholesaler, whatever it may be. The second category of properties are mixed use, which is where you have residential, people, habitational exposure, people living in the property typically in the second, third, fourth floors and above, while there's commercial real estate on the main floor. And then the third type of property would be just residential only, where it is considered commercial because it's an apartment building. Anything over 4 units in the insurance world is considered commercial. And again, where it's over 4 units and strictly just habitational, people living there with their families, and it's their place of residence. So depending upon what type of property is, again, it's size and then exposures. What I mean by exposures are, if it is a commercial tenant, what is the commercial occupancy? Is it a restaurant? Is it a manufacturer? Is it a retail clothing store? What types of things are in that business that could potentially impact the property and liability exposures that an underwriter is looking at? Those types of things will impact what companies we can go to and how much premium they charge. So when you are looking at buying a property, you definitely, and there is a commercial exposure in there, you definitely want to put into consideration what type of exposure they're going to bring in, because that will impact the cost of the policy. And then the last thing I point out is risk tolerance, and really the main thing that will drive your risk tolerance, not necessarily drive your risk tolerance, what can be impacted by it is your deductible, how high you're willing to go and how much you're willing to cover, as well as what type of policy you're buying, which it goes into the next line here. So I have a note here that says coverage versus premiums, ACV versus RC. ACV stands for actual cash value. RC stands for replacement cost. So, in asking what's your risk tolerance, there's different nuances to actual cash value and replacement cost, which I'm going to touch on in a couple of more slides. But that's something that is going to tie directly into your premium and how much exposure you're willing to take on as the investor and owner of the property, versus replacement cost. And then again, deductibles. In my opinion, the ultimate goal is finding the right balance between the coverage and the premiums and your risk tolerance, so that the policy is going to react the way you expect it to when the claim happens. And I say that's the second time I've said it. It's because more often than not, I will meet, I'll sit down with an insured, I'll go present a policy, show them what their options are. They'll select the policy, and then it might be 3 years later there's a claim, and all of a sudden it doesn't pan out or play out exactly the way they expected it to or wanted it to, and it was based on a decision that they made years ago. So if you have a good agent and a good agency behind you, this is something that you're going to review on an annual basis, to make sure that like I said, when a claim happens, the policy responds the way you're hoping it or expecting it to. The first part before you ultimately start buying a policy is that you've got to choose your insurance agent. There are obviously tons of different types of agencies out there. The two main categories that I lump them into is an independent agent versus a direct writer or captive agency. The easiest analogy or easiest description I can give you of these, an independent agency is what we are. We represent about 40 different companies, and ultimately we work for you, representing you to the insurance companies to find you options. We do not, yes, we have relationships with all of the insurance companies, but ultimately, again, we work for you. A direct writer or a captive agent is someone who works for the company and they sell the company's products. So in the, Tal, there's people here from all over. Is it mostly Israel and US?
We have people from all over, but most of the people that are here are involved somehow in real estate in the United States. So
okay, perfect.
US investing related zone.
Okay. All right. So, you know, a lot of the companies that you'll see like direct writers are companies like State Farm or Geico or Nationwide, Allstate. Those are all direct writers. So if you call one of them for a quote, the only companies they have access to are the company they work for. So they're really selling a product that's in the best interest of the company ultimately. An independent agent like myself represents you and has access to multiple companies to try and find you what your best option is. Now, within that, there's a local agency versus national agencies. If you are going to be doing business all over the 50 states, or at least multiple states, you're going to need a national agent. You're going to need someone that has a large agency footprint throughout the country. I would suggest and recommend that if you have the ability to work with a local agency, to do so over a national one, primarily because the local agencies, like for example, for us, I would call us a local agency. We do work in multiple states, but ultimately our focus is in New York. The benefit to that is that we are familiar with the companies that are really good in New York State. Now, again, we write in Ohio and Pennsylvania and Florida and California, and we have companies for it, but our resources are really focused more to New York driven opportunities. And every local agency is going to work like that. So if you're, you know, it's going to be beneficial to you to find a local agent in whatever states you're going for, unless you have a huge portfolio that's going to be really nationwide, then you kind of, you know, you need to go to a national agent. I have a sentence here that basically states just what I believe the other main integral part in choosing your insurance agent. You want your agent to be able to underwrite your portfolio, field underwrite it, go to market with your account, and then come back to you with what options are truly available to you, giving you the ability to make an educated decision from both a coverage and premium perspective, because that's really what makes up what you're doing here from an insurance world is what am I getting and what does it cost? And what's the best way to maximize that within my risk tolerance? I do always put a note here. You know, not all agents are good or necessarily honest. And there's a lot of times, you know, when I'm in competition with other agents for an account, things are not always underwritten properly. And I do suggest you know, if an agent that you're talking to or working with either encourages you or is willing to play in what I call the gray area, be wary, because it may save you money up front, but at the time of claim, it could cost you a lot more than what you save on that initial policy. And I always say, if they're willing to lie for you, they're willing to lie to you. And you know, that never works out to be a good formula. Real quickly, in choosing an insurance company, whenever your agent brings the options to the table, you know, not all companies are created equal as well. You definitely want to inquire about their claim service, billing departments, make sure that they have a strong financial rating. There is an organization called AM Best. It's kind of like the Better Business Bureau of insurance for insurance companies. They rate insurance companies on their financial strength, their ability to pay out on claims, their user friendliness between the buyers and the insurance companies, and they give them a rating based on all of those things. My suggestion would really be to not work with a company that's not A-rated. You know, there's different tiers, but I would recommend staying with an A-rated carrier plus. And the reason why is there's a lot of good A-rated companies. You don't need to go into anything under A-rated. There's financial concerns. There are smaller regional companies, and there tends to be issues with them. And outside of just asking your agent, I would recommend, you know, going onto Google and doing a little bit of a check on whatever company is that you're you know, potentially going to work with. Realize every company you look up, there's going to be, you know, someone's going to be upset with something they did or something they handled, but you'll be able to tell if there's a high volume of problems with a certain carrier, and you want to use that in weighing your decision if you're going to purchase insurance from them. Now, getting into the actual coverages that you as an investor are going to be purchasing, there's really two main buckets of coverage. One of them is the property coverage and the other is the liability coverage. And I'm going to talk a little bit about both. If you have a loan on the property, you are most likely going to be required to carry property insurance to ultimately protect the lender and their financial interest on the property. If there's no loan, the choice is yours. Now, I would still highly recommend purchasing property insurance, even if it's your money that's buying the property. This is where, though, going back to one of the beginning slides, this is where you have to decide how you want to insure the property. There are a couple of different ways to do it, but ultimately the two most practical and most common that you'll see in the industry is replacement cost coverage versus actual cash value. Replacement cost coverage is just like it sounds. It's the cost to clean up the mess. So if there's a fire at the building, you've got to clean up the location and give yourself the ability to rebuild. So there's costs involved with demolition as well as carting it all away. And it also includes the cost to build a new building with today's materials based on labor, material, gas prices, things like that. So replacement is going to rebuild your building with new materials today. Actual cash value, the definition of that is replacement cost less depreciation. So let's just say, for example, the replacement cost of the building is $100,000 and the building is 25 years old. Well, let's say the building's 10 years old. A roof expectancy on an average, asphalt shingle roof is 20 years. Let's say the roof were to blow off in a windstorm. The roof's 20 years old, and say the roof costs $20,000 to replace. The replacement cost of the roof is $20,000. They're going to put depreciation into play. The life expectancy is 10 years. They're going to say that the depreciated value of the roof is $10,000. So what they'll do is pay replacement cost less depreciation, $20,000 minus the $10,000 that's depreciated. You're actually only going to get $10,000 for the roof that just blew off, but you have a $20,000 bill with your contractor to replace the roof on the building. Now, some might say, well, why would I even consider insuring actual cash value? And primarily the only reason you would is to try and offset the cost of the insurance to work into your formula of overhead expenses to make the property either profitable, or the other times that I'll see it is on lower cost investments where you might not be too concerned with if the property was destroyed. You may just, clean up the mess and sell the lot off and be okay with it because your money in is not a big enough risk to pay the higher expense on the insurance premium.
I'm gonna stop you here for a second, Mike. Guys, this is a very important point what Mike just mentioned, and I want to make sure that everybody on the same page. You guys understand the difference of what he explained? Anybody didn't understand?
I'm going to actually give a claim scenario that ties into that. I've got it on the bottom of the slide, but I'm happy to do it now because it really does point out what this can do. The other thing is that I'll tell you that many times I've seen in a competitive state of me in there with another agent, and they get a quote from one agent, I give them a quote. I might be $1,000 a year higher, again, making up the numbers to illustrate the point. But ultimately I'm $1,000 higher and their quote is actual cash value. Mine is replacement cost, substantially different coverage. And the investor buying just didn't even notice that the quote that they had from the other agent was actual cash value. It can literally be tens of thousands, if not hundreds of thousands of dollars in a claim scenario. If you purchase, not necessarily the wrong coverage, it's okay to buy actual cash value. As long as you know that you're doing that and you're taking on that risk and exposure in the event of a claim. The claim scenario I was going to give you is I actually had an insured who bought a 6,000 square foot mixed use building, residential on the top 2 stories and commercial. It was a restaurant on the main floor. I got some notes here on the claim here that I pulled up. And there was a grease fire from the hood system. They didn't have the hood cleaned out properly, and there was a fire that ended up destroyed the entire main floor that the restaurant was in, and also almost a little bit over half of the second story that had all the residential apartments. From a property side, there was substantial, approximately 50% of the building was destroyed. From a liability perspective, there was an issue because one of the people living in the apartments was hurt pretty badly. But that's another thing that we'll talk about in a little bit with liability coverage and umbrella policies. But from a property side of things, he insured the property on an actual cash value basis. He purchased the building for $300,000. Even though I recommended the replacement cost policy, he had it stuck in his head that he only had $300,000 into the property, and that was really all he was concerned about. The problem was only half the building burned down. And now he has ultimately it was a $200,000 claim to do all the repairs on the building. But because it was insured for actual cash value, they depreciated it by 60%. Now, I will also tell you that every company's formula for depreciation is different. They're all based on the same premise, but there's really, I wish I could tell you this is exactly how the formula works. I cannot. What I can tell you is that the insurance company typically is going to try and push it in their favor, not yours. And ultimately, there was a $200,000 claim depreciated by 60%. So the insured received $80,000 and had a $200,000 repair bill.
Can I ask a question?
Yes.
When I'm trying to get insurance, they ask me how old is the roof. So if I get a claim for the roof, will I have to prove that the roof is like, if I say I own the house for 1 year, but I'm guessing the roof is 5 years, will they ask me to prove it how old it is?
So if you have replacement cost coverage, no, because they're just going to replace, the contract says they have to replace the roof regardless of whether it was 20 years old or 5 years old. If it's actual cash value, they are absolutely going to try and get an answer in regards to how old the roof is, because they will use that in their depreciation formula. If they cannot, or you cannot, they will send a roofing contractor or specialist out to the claim site and try and find something that they can reference get an estimated age of the building, of the roof. Now, if the roof is completely destroyed and there's nothing there for them to look at, they're going to go off of the application. So if you said 5 years old, then they will use 5 years in the depreciation formula to calculate what the actual cash value of the roof is at the time of loss.
So it's always better to say the roof is 3 years old or 1 year old?
It's always better to say the truth.
Of course,
yeah,
but I own the house for a year, so I don't know how old is the roof.
I think you want to do what's, I always try and approach it in what's fair. Obviously you buy the house, you don't know exactly how old the roof is, but you can go out and look at, if you're able to look at the roof, if the shingles are curling and it looks like it's 20 years old, I wouldn't tell them it's 3 years old. No. If the roof looks like it's in fair condition, give a good faith best guess estimate of what the roof, what year, how old you think the roof is. But yes, the younger the roof is, the less it will be depreciated at time of loss, because that's what they're going off of, is life expectancy of the material.
Ari, I'm gonna add something here. One of the best indication to understand the age of the roof is to ask the owner. If your owner, somebody bought this house 10 years and he didn't do the roof, it's older than 10.
Yep.
If he did it in the last 10 years, you're going to say, I don't remember, but I did it. So at least you know that it's in the 10 years range. So now you have an estimation. But if somebody that owned, that at least you have, sorry, I'm going to use a Hebrew term here, יש לך גבול ברבור. If you know, אם אתה יודע כמה זמן הוא הבעלים של הנכס, יש לך גבול ברבור לזמן של הגיל של הגג.
לפעמים אבל לפעמים העסקאות זה wholesaling ואין לך קשר טוב עם הבעל בית.
I'm saying, of course, if you don't know exactly, you try to do your best. The idea is, and Mike used this term. There is a term in Hebrew, in English says good faith. Your best guess. You're giving your best guess.
Is the roof age, does it impact the premium if I'm doing a cash value, not replacement?
So no, it ultimately doesn't impact premium. It impacts eligibility, and most underwriters will not write. They'll stray away from it if the roof is 20 years plus, or getting close to that 20-year mark. 19 years, 20 years. So I shouldn't say it doesn't impact premium at all. In New York State or in most in the United States, there's a 10% leeway that companies have when they're looking at a quote. So let's say the premium they're coming up with is $500 a year. They have a leeway of 10% in either direction to release the quote. So if the roof is 18 years old, they're not gonna, it will play some impact on premium, but not greatly. It really has more to do with eligibility, and they want to see that the property has been maintained.
I'm going to say another thing about this, Harry. Don't forget, they're going to send somebody to take a look and give them their own. So you saying 5 years, and he come over there and he see that the roof looked like 20. They're going to come back and say, listen, it looks like 20. It's not like, oh, he said 5, so it's fine. They're actually sending somebody to take a look.
Yes.
Take a look at the property.
Thank you.
Sure.
Carl, can I ask a question?
Yeah, of course.
So I'm wondering, I recently seen a big difference in some of the quotes that I'm giving and what the agents from different companies use for replacement value.
Mm-hmm.
And sometimes it's because of just a very blatant mistake, and sometimes it just, I don't know if it's based on comps or what. How do they determine that, and what should we as the client be looking out for in order to make sure we're getting the right amount?
It's a great question. Ultimately, as many of you may know, the cost of labor, materials, gasoline has, drastically increased over the last 2 years, which obviously drives up the cost of rebuilding. As insurance agents, we are not contractors. Insurance companies provide us with a replacement cost estimator software. So when, if you called into me and asked, for a proposal on a policy on a location you were looking at buying, I have an intake form that I would take square footage, age of construction, last known updates to the roof, the electrical, the plumbing, the heating and air conditioning. Is the basement finished? Is it on a slab? There's a slew of underwriting questions. And the reason why I'm doing that is, one, for eligibility, but two, I'm going to take that intake form and I'm going to input that information into the replacement cost estimator platform. And at the end of it, it's going to spit out a number. It has nothing to do with market value, has nothing to do with assessed value, has nothing to do with purchase price. It's solely based on what the system, the insurance company's software system tells them this is what the replacement cost is for that property based on this information. Now, I will tell you that I don't think there's an insurance agent out there that generally will release that. It's not that they're hiding it. It's not part of the general process. But I do have 1 or 2 clients that will ask for it, and I will send them a copy of the estimator. It comes out in a nice PDF, and you can review it and you can see what they're using to come up with that estimated replacement cost. Every company, most of the companies have their own software, but most of them are working off of the platform base is the same. They go in and do a couple of tweaks to it and make it their own. But ultimately, they're if I take that intake and I put it into Traveler's estimator and Hartford's estimator, I'm probably going to be within 5% of each other. But I think to better answer your question is, you as an investor, if you're seeing large discrepancies like that in the estimated replacement cost, it usually means either someone's not doing their job completely. Maybe they just pulled some stuff off. They didn't ask you all those questions. They pulled some stuff off of the internet, off Trulia or Zillow or the MLS, and they're just inputting whatever that says. and or maybe even answering some of the questions themselves without really knowing the true answer.
So when you know, okay, besides from like situations where there's discrepancy, which I've come upon frequently, I've also had, like I once had like a very small Philadelphia row house. I don't know if you know the Philadelphia market at all, but that I was given over $300,000 for replacement cost. And that was like impossible. And there was nothing I could do to convince them that it made no sense. So I ended up going somewhere else, but.
Did you ask them to see the estimating, the replacement cost estimator how they came up to that value?
No, they just insisted that's what they're getting, and that's all they weren't gonna get into things with me.
So then, not to be crass, but I would probably find a different insurance agent. And don't get me wrong, I have that happens all the time in the city of Rochester here. You could go in and buy a property for, $30,000 purchase price, and the replacement cost has come in at, $400,000 because they're 5,000 square foot homes that were built 100 years ago. And when I show someone an estimator for $400,000, their eyes pop out of their head and they're like, "What are you talking about?" And when you show them, the other thing too is the average cost of construction for a residential single family or two family home. It used to be $125 to $175 a square foot was standard average market cost marketplace cost to estimate the replacement cost of a home. What we're seeing now is closer to $175 to $225 replacement cost per square foot. So, you can do also simple math and look at it. If it's outside of that, if you've got a quote that's a 2,000 square foot home and it's coming in at, $350 a square foot, that there's something wrong. And that's where you either press the agent to say, "Let me see the replacement cost estimator to make sure it's accurate." And if they won't do that, then you should find an agent who will, because, their goal should be to write the policy, but to do it fairly and with the correct info and show that to you.
Okay, that's helpful. Thanks.
Yep.
I think we bought the property, what was it? $495, and it's sold for $2 million because of the replacement cost. So I bought the property for $500,000 and it's insured for $2 million replacement cost. That is the difference between the purchase price and the replacement cost now.
Yeah. It's very common to see large differences in that, depending upon the demographic. There's the flip side to that too. We live in upstate New York. There's an area called the Finger Lakes, and we have some, there's Canandaigua Lake, which is one of the most expensive, places to build a home. And I just had a situation where the homeowner purchased a lake house for $2 million, and the estimated replacement cost of the house was $750,000. The insurance, the bank is looking at them saying, "Well, we want $2 million worth of insurance," and the insurance company saying, "We're not going to give you $2 million of insurance because it's only going to cost us $750 to replace it," and that creates a moral hazard. So, the value is in the land and the location because it's right on the side of, a lake. But there's flip sides to that as well. So, but more often than not, from an investment standpoint, you're going to see the side that Tyler spoke of. The purchase price is a lot less than the replacement cost. Did I lose you?
No, you're good. Just for a second.
Are we back?
Yeah, we're good.
Okay.
Let's continue.
So, yep. So in the property coverage section, we touched on replacement costs and actual cash value. The ITV stands for insuring to value. Insurance companies want you to insure to the replacement cost, which is part of what Cheryl was asking about there. They wouldn't budge on lowering it when you felt the cost was inflated. The reason why they want you to insure to value is ultimately because insurance platform works on everyone paying in to a pool of money. There's so many claims. There's enough money to cover the claims for the people that have claims. There's money there for them to pay for the costs of the insurance company, and then for them to make a profit. That only works if those actuary tables only work if they insure the properties to value. When when they don't insure the value, which would be actual cash value basis, they're going to charge you a little bit for it. So what the reason why I put this in here, the ITV section, is what you'll find most often is you'll get two quotes, one for replacement cost, one for actual cash value, and the premium difference is not that substantial. So I really would recommend and steer you in the direction of getting, if you're concerned about the premium of it, get both quotes and see the difference and play with the deductibles to get it into the premium range that's comfortable for the numbers to work for your investment. I do want to talk briefly about coinsurance. This is something that's overlooked many times. The way this works is insurance companies there's a coinsurance clause on every insurance policy, and it's either 80, 90, or 100%, generally speaking. There's a couple of times it falls outside of that, but 99% of the time it's going to be 80, 90, or 100%. So where this comes into play is, again, this ties into the insured value. Insurance companies want you to insure what that replacement cost estimator says is the replacement cost value. If you don't, let's say they tell you the value is 100,000 and the coinsurance clause on your policy is 80%. What that contract says is that you're agreeing to pay to insure to at least 80%, or you become a co-insurer. So let's say you say to yourself, you know what, I've got a high risk tolerance, I want to save premium. You're telling me I've got to insure at least 80% of 100,000, which is 80,000. I don't think there's ever going to be a total loss on this building. It's a bomb shelter. It's made out of concrete. It's not going anywhere. I'm going to insure it for $40,000. So you're insured to 50% of what they're asking you to insure. They want 80,000. You're insuring for 40. If a claim happens and there's a $100,000 claim, you've only insured to 50% of what they're asking. They're only going to pay 50% of the claim. So you have become a co-insurer on that policy. So this is one of the fine print things that you want to make sure when you're buying a policy, that you are meeting the co-insurance requirements. Otherwise, you could have a very big issue come claim time. Does that make sense? I kind of, I oversimplified the formula, but that's, if it's 100% co-insurance, you have to use 100% of the replacement cost estimator. So if they want if the 100% is 100,000 and you insure for 90, you're 90% insured, they pay 90% of the claim. Make sense?
Everybody understand what Mike just explained? It's too quiet. Nobody talks. Everybody.
Isn't it just the same? Isn't it just the same as saying they will pay up to whatever you're covered? So if you're
sorry,
covered,
say that again.
Isn't it the same as saying if you're covered for 40,000, they will only pay up to 40,000? Or if the claim is 40,000, if they wanted you to insure it for 80,000 and the claim is 40,000, so they're still going to pay just half of the claim, so they're going to pay you.
They will. So the limit of the policy is the most they will ever pay out ever. But again, if they can get away with paying less, they're going to pay less. And this is one of the ways they do it in regards to co-insurance. So let's say you insure the property for $40,000 and there's a $40,000 claim. That doesn't mean you're going to get $40,000 just because you're insured for $40,000. What they're going to do is, let's say the house burns to the ground. Or it's not a problem if it's a total loss usually, because they're going to pay you the full 40,000 because the total loss is going to get you above that 40,000. But the co-insurance will still apply if you're not carrying the insured value percentage. So if they say, let's say you buy a property and they say you have to be at least 80% insured to value, and the replacement cost is $200,000. So at 80%, you need to be carrying $160,000, and you're only carrying 40. You're 25% insured. So if the claim's $40,000 and you're not going to get $40,000, you're going to get $10,000, even though you're insured for the 40. So the limit of the policy does not come into play if you're under the co-insurance. So that if you meet the percentage, then yes, they'll pay the full amount up to that 40.
Co-insurance should be 100% or as low as possible.
So so it's typically either 80, 90, or 100% on a replacement cost policy. It's 60% on an actual cash value policy. If you do 100%, the premium's actually better. So that they lower the premium if you insure the value 100%. If you want 80 or 90%, you pay a little bit for it on the rate per 100 of coverage, but you don't have to insure that $2 million building at 2 million. You can now insure it at 1.6 because you're at 80%. Does that make sense?
But you said the premium is going to be lower?
So there's two variables that you're looking at here. So there's a property rate for every $1,000 of coverage that they come up with, that they establish based on other variables, so that I'll go over in a little bit. So if you buy $1.5 million worth of coverage at that property rate, that property rate is set for 80% coinsurance, and then there's another property rate for 90% coinsurance or 100% coinsurance. The closer you go to the 100%, the better the property rate is, because you're insuring it for what the insurance company wants you to insure for. But as a result, you're buying more insurance. Instead of insuring that building for 1.6, you're now insuring it for 2 million, because you have to meet that 100% coinsurance clause. So you pay more in premium for the policy, but the rate is actually better for the amount per thousand that they're charging. Make sense?
Yeah, makes sense.
The property rate is better at 100% coinsurance, but you have to insure 100% the value. The rate is higher at 80%, but you're insuring at a lower number because you only have to go to 80%.
Yeah.
And again, yep.
What does it mean if you purchase a replacement cost for, let's say, 100,000, and you are co-insured only 80%?
So that means if they're telling you their replacement cost is 100,000 and the co-insurance is 80%, as long as you insure for $80,000, there is no co-insurance penalty. The only deduction you will have is your deductible at the time of loss.
So they will give me only 80,000 for total loss?
They would give you, yep, the max they will pay out is the 80,000.
And if it's only 50,000 damage, they will pay me 80% of that?
Nope. If you're insured to 80% or more on a replacement cost policy, they will pay the full amount of the claim less deductible up to 80,000. If you're under that 80% co-insurance clause, then what you just suggested is how the claim would play out. If you're under 80%, they're only going to pay the percentage that you are insured for that they're requiring from you. So on a replacement cost policy, you want to always insure for 80% or better. Otherwise, you will pay penalties at time of claim.
Okay, thank you.
Yep. Again, really how you decide to do this is ultimately what is your risk tolerance, and what I suggest is really asking your agent to quote it a couple of different ways so that you can look at it and make an educated decision based on what you need. You got a couple of different things that you're juggling here. You're juggling the cost of insurance and how much coverage you're getting and how that all fits into your risk tolerance and the numbers and your profitability of this investment property. So there are ways to play with it a little bit, and if you have a good agent, I always tell where are you trying to get to? Not just the cheapest possible. Where do you need this price to be? And let me show you the different coverage options you have to try and get you as close as I can to that premium. And I think a good agent can should be able to do that for you and show you that. And then you make an educated decision. So that is the property side of things that I wanted to touch on. General liability is a little, I think it's a little simpler. This is really what's covering your entity or yourself if the property is in your personal name. which I don't suggest, but that's another discussion. But ultimately, general liability insurance is covering your entity or yourself for claims that arise out of bodily injury or property damage. So someone gets hurt on your property, or you damage their property. In real estate investment world, there's really not much of an exposure for you to damage someone else's property, because your service and your product isn't something that you're giving to, giving to them outside of the property. So really the most common thing that you're going to see are slip and falls, whether it's, the icy driveway or the icy walkway in front of the store, or a handrail missing on a staircase, things like that. It will also cover personal and advertising injury if you are advertising.
How do you know how much is enough, right? I mean, somebody can slip and fall and you can sue you for $5 million. Somebody else can sue you for $100,000.
Yep. So it's a great question. I always answer that with, tell me how much you're going to get sued, and I'll tell you how much insurance you should buy. I'm actually going to talk a little bit about that in more depth when we get to the umbrella policy. So if you can hold on for one minute, I think it's probably the next slide. I'll be able to kind of hit on that in a little more depth. Outside of personal advertising injury, the purpose of your general liability policy is to cover a settlement or an award to the injured party. And the other big ticket item is defense costs. Sorry. By having general liability insurance on your policy, it's giving you a lawyer to defend the claim.
Usually, usually, and I'm saying it unfortunately out of experience, what happened when it happened to us recently, actually, luckily for us, it ended up with nothing. Actually, when you have somebody suing you, what you have is that the insurance company takes over, and their attorney and their investigator goes to check out what really happened. So
yeah, and realize, insurance companies are not in the business of writing checks. They want to cash checks, just like you guys.
they're on your side.
When it comes to a liability suit, 100% they're on your side, because they don't want to write that check any more than, that's not profitable for them. So they are going to do everything and anything they can to try and, make that claim settlement as low as possible. I mentioned slip and falls. The other thing is clear walkways, uneven pavement, things like tripping hazards, things like that are what what generally push these claims through. The standard liability policy, or portion of a policy for us, we write as $1 million liability. That defense coverage is outside that limit of insurance. So you will get unlimited defense coverage for that suit that does not erode the $1 million. The $1 million is for settlement or award. How much coverage should I have? It's the world we live in today. It is a lot more. The legal climate is it's not like what it used to be, and $1 million isn't what it used to be. Personally, I myself do have some rental properties. I have them in an LLC, so that does assist in some offering a corporate veil to my personal assets. But I won't operate with less than $3 million worth of liability coverage. My goal when I'm buying insurance is I want enough insurance that the company is the one writing the check, not me, and I'm not liquidating assets to pay a claim that I could have insured through an umbrella policy and the standard liability policy. Umbrella policies work just like they sound. They go over, in this case, in most of your cases, it's really just going to be excess liability insurance. The reason why they call them umbrella is because if you have commercial auto or you have other liability exposures underneath, the umbrella policy will go over all of those policies. So like in the personal side of things, your home and auto, if you have an umbrella policy, it goes over both your home and auto policies, so that if the underlying policy is exhausted in a claim, the umbrella will then step in. Most real estate investment products for the insurance market, they'll offer 500,000, 1 million, and some of them will offer 2 million on the base policy. If they offer 2 million on the base policy, I think you should take it. It's the least expensive way to really afford yourself some extra coverage. If they only do the 1 million in liability, I don't think this day and age that you should be operating without doing one of two things, either having an additional million or more in excess liability, or shielding yourself through corporations, LLCs. And again, this will get into a little bit of the legal world, which is, I'm not an attorney, but separating properties into multiple entities shields you from, if there's a claim on one, it doesn't carry through all of them from both a claim perspective and a premium perspective on those other properties. So, one claim in one place doesn't mess up the rest of your policies and liability exposure on the other locations.
And if you have LLCs, is your personal umbrella covers all the LLCs as well, or you need to do per LLC another umbrella or something of that sort?
Yep. So personal umbrellas will exclude business operations. So a personal umbrella will include a rental property if it's in your personal name. Again, up to 4 units, because after that it's considered commercial and they won't do it. But a property owned in an LLC will be excluded from your personal umbrella policy.
So you need additional umbrella for that, or it's a different name?
Additional, yeah, you need a separate umbrella in the name of the LLC.
So each entity will need its own umbrella.
You may, if you have multiple entities, you are able to buy, and as long as there's common ownership, meaning that there's 51% ownership amongst same ownership amongst all of the entities, you can buy one umbrella, list 10 named insureds or additional insureds. So if you've got 10 different LLCs, you can do one umbrella over all 10 in multiple, you do a $5 million umbrella over all 10 entities, as long as there's 51% common ownership amongst those entities.
Okay. And regarding coverage, you might not have an answer, but I heard from somebody else that owns properties that his house was blown up by one of the tenants doing something illegal, and the family sued them for 30 million. I mean, you keep insurance for 1, 2, 3 million, but I don't know anybody that keeps 30 million insurance for one property.
No.
How do you protect yourself from those kind of cases?
So, I mean, you're correct. I mean, I'll tell you right now, in my 15 years, the largest umbrella I've ever written was $20 million. It was once, it's one account that we have that. I have a few that are 10 million. The vast majority are 5 million or less. The only way to protect yourself against, I mean, just because they sue for 30 million doesn't mean they're going to get 30 million.
Right.
Typically what you'll see is it'll exhaust the attorney. Will look at the claimant and say, we're not going to get 30 million. We'll ask for 30 million. They have 5. This is our best way to get the 5, then to have the insurance company just stroke the check. And they'll usually end up settling for whatever the maximum limit of the policy is. The only way to really shield yourself against that, you ultimately you can't. You want to have. That's why I think you want to have a few $1 million, $2-3 million, per property, or an umbrella that goes over multiple entities, like I suggested earlier, and hopefully that worst case scenarios, you'd have to liquidate that LLC and sell off the property. But by having multiple LLCs, you are shielding the other assets from your other LLCs.
Right. And last question.
Let's say it like this, let's say it like this. If you have $100 million property, don't insure it for 1 million.
No, of course. I'm talking about one rental, right? One more question. So how many events are you covered with the umbrella? Let's say you have 2 or 3 properties, you covered for 3-5 million. You have an event in one property, and then in the same year, another 2 events in the other properties. Each of them is covered by 5 million, or
no? Most of the umbrellas are an aggregate limit for the policy period. So the most they'll pay out over one policy term is that amount.
Oh,
there
so
are
you're not covered after that.
You have, once that umbrella amount is exhausted, there's no additional coverage. So if you had a $5 million umbrella and you had a $2 million claim, you'd have $3 million left for the balance of that policy term. You can get, it's not common, but you can get it where it's a 5 million, 10 million. So you'd have 5 million max per claim, 10 million over the policy term. But generally speaking, most umbrellas are going to be written on an aggregate policy form. So that limit is the limit for the year. But if you request alternate, you can get it.
Can you repeat again? You said in the beginning of this part something like that the umbrella, if it's in your personal name, it's not going to cover properties in your LLC. And I'm just curious because, like, I think that my umbrella is in my name, but I am very diligent about making sure there's a list provided and agreed to with the insurer of all of my properties that are covered under that umbrella.
So are the properties in LLCs?
It's a mixture.
So if I, Mike Broker, buy a rental property, a single family rental property, and have a personal umbrella policy over my primary home and my auto, I can include a rental property that's maximum 4 units under my personal umbrella policy, as long as the property is owned and deeded to Mike Broker. If Mike Broker forms MB Real Estate LLC, you will see on every umbrella policy form I've ever read, there is an exclusion for business operations. And it will state exclusions for, real estate owned by corporations.
Cheryl, does the insurance company knows that it's under LLC, or they just know the addresses?
They know it. Yeah, they know everything. But when you say LLC, so what about a single member LLC, which is what's most common, I think, among this crowd?
Yeah, no, I'm pretty confident in stating that that they, do you mind sharing what insurance company it is?
I switched around. Which does the umbrella?
Well, so yeah, so I can't state for, like Allstate and the captive agencies, the State Farms, the Nationwides, the Allstates,
Hudson.
Hudson Specialty is an excess lines carrier.
Okay, well, now I know to check this.
It's possible. Excess lines is where we go to insure when everyone else says no. So there's a possibility that Hudson Specialty does allow you to have an LLC and a private, your personal name listed, but you're paying a premium for that umbrella.
Okay.
There's you're paying more for that ability. So there's a possibility you may be able to. I would consider exploring, a personal umbrella that just lists property in your personal name, and a commercial umbrella, not with Hudson, not with excess lines, that will insure the LLCs.
Okay, thanks.
Yep.
I appreciate that.
Yep. All right. Any other questions on excess liability or regular liability?
Yes, before when you said the policy term is usually 1 year, right?
Correct.
Thanks.
My question about the slide before of the commercial general. Yes, this one. So is it part of my regular insurance for the property, or it's a different insurance that I need to do?
No, I would assume that you should have what's called a package policy, and it's 2 parts: the property, which covers the building, the structure itself, and then there should be a section on the policy that's general liability, and that would cover, the slip and falls, bodily injury, occurring at the location.
So I only need to check on the amount that I'm insured on.
Yes,
Yeah.
I mean, I would, without seeing it, I can't 100% say, but I would be hard pressed to see that you don't have general liability on your policy. It's really a matter of how much, and are you comfortable with how much it is.
Okay, thank you.
I would recommend not carrying in the United States, I would not carry less than $1 million worth of liability. That would be the bare minimum. and recommend at least exploring additional coverage through an umbrella policy to make an educated decision as to the cost and whether or not you think the value add of that coverage, warrants it. Okay. I'm not going to go too deep into this. This is getting into the trenches a little bit, like I say, but one of the things you do want to look at on your policies is there's 3 main policy form types: basic, broad, and special. And so again, not all insurance policies are created equal. There certain underwriters will only allow certain policy forms on certain properties. So like if the property is maybe a little run down, needs work, there's going to be renovations, they're not going to give you a special form policy. They're most likely going to write it on a basic or broad policy form. And you want to look at this also when you're comparing quotes from multiple agents, if that's what you're doing. The premiums are obviously one thing, but what policy form are they writing it on? Basic, broad, or special? Because the main difference is you'll see basic policy forms will cover you for what you see here: fire, lightning, wind, hail, explosion, smoke, vandalism, aircraft collision, riot, and civil commotion. You'll note that's the minimum coverages that a policy will afford you. A broad form policy will include everything that's in the basic, but also add theft, falling objects, collapse from weight of snow, frozen pipes, accidental water damage, artificially generated electricity, and sinkhole collapse. Special form covers everything except for what they specifically exclude. So they say everything's covered except for this. And it's a lot easier to look at those because you can say, all right, these are the things that aren't covered, everything else is. But there is very real premium differences between these 3 policy forms. And, a lot of times with some of the investors that I work with, they buy a property that might be a little distressed. Their intention is to, they buy it at a good price. Maybe it's a foreclosure. They go in, they put a little bit of work into it, dress it up a little, and then either flip it or rent it out. And we'll start it off with the basic or a broad, depending upon what the underwriter is going to allow us to do. And then once the work's completed, we will communicate with the investor and make sure we're staying in touch with each other so that when it is completed, our ultimate goal is to get it on a special form policy, because that's where you're going to have your best coverage. Sometimes we can't, or sometimes the company will say, hey, we went out and inspected and you need to fix this and this before we'll do a special form. But ultimately, in my opinion, your goal should always be to have a special form policy on any property that you are investing in.
What about the flood and earthquake? If you're not in a flood zone, do you still need to buy extra flood insurance, or it's covered usually?
Excellent question. So flood insurance is not on any policies, any standard issue policy from a carrier, at least in New York State. I can confirm that 100% in New York State. I believe that's the case throughout the country. Flood has to be purchased separately through FEMA. And it can be, some companies will have an endorsement that they can add it on, but most of them don't like to do it. Now, flood, remember, is not you have a broken pipe and the basement, it drips down through the ceiling. That's a frozen pipe or a accidental water discharge. Flood is rising water coming from the outside into the home, or into the property. But flood is going to be excluded. You can buy it through FEMA. If you are not in a flood zone, you are not required. It really comes down to the lender. If the lender doesn't require it, you're not required to buy it. If there is no lender involved and you are in a flood zone, the choice is yours. But it will not. You should go into purchasing any and every property with the understanding that flood is not included on your policy.
Okay, thank you.
Earthquake can be added by endorsement by your standard carriers. So if I wrote your policy with Travelers, they have an endorsement to add earthquake coverage. I will tell you that most agents are not going to automatically add it. It's not going to be a default coverage. But if you request it, we can absolutely put it on. Any other questions on the types of policy forms?
Yes, about the flood insurance. I understood there was recently a new law that states that other like, private companies could insure for flood, other companies besides FEMA as a governmental company.
Yeah, there is another company, a brokerage that I've seen. I think it's called Cat Loss, standing for catastrophic loss. We have just started to use them. They are the law is that, yes, you're correct in saying that the law was passed that makes it so that you can purchase it outside of FEMA. What I'm finding or seeing though is that the lenders, typically if it's a standard banking financial institution, they're not accepting the other policies yet. Where they're only taking the FEMA endorsed and backed policies. The difference between the two is that the FEMA policies are backed by the federal government, whereas, and I don't know if that's always necessarily any better than not being, but the other companies, the cat losses, it's just a standard insurance company that may or may not be able to do business in certain states. So if you are in a flood zone, you definitely want to have that question, or when you're looking at properties, you do want to, before you put in offers, you definitely want to confirm that whether it is or isn't in a flood zone. If it is, what the cost of insuring it is, especially if there's a lender involved and you're using someone else's money to purchase.
Yeah, I was just saying that because I've seen in the last property that I bought, it is in a flood zone and we do have a flood insurance. And I was expecting the flood insurance to be a lot higher than my previous, like according to my previous experience in other flood zones. So I was expecting the insurance to be higher, and it was lower than expected. And this is what my insurance agent told me about this law, that kind of dropped down the prices. It's still FEMA, but it dropped down FEMA's price as well.
To be honest, we don't have a ton of flood zone out here, so we don't quote the flood policies frequently. The policy you purchased was through FEMA?
I'm 90% sure about that, but
so I will say that the company Cat Loss that does the flood policies, they are 50% of the premium. If I quote the same account with the FEMA backed or the other company, the new company is half the price that FEMA has been. It's a matter of whether or not the lender will approve it. So I would, before you get the quote, that's great, but I would confirm with the lender, if there's one involved, that it will be acceptable to them.
Yeah, the lender approved it. So yeah. Thank you.
Yeah. All right. The next thing I wanted to talk about was a little bit of just underwriting considerations. You folks are looking at properties and considering them as an investment opportunity. These are the things that the underwriter is going to put into consideration when coming up with, one, is it a property that's eligible for our programs, and two, how aggressively they want to pursue the account from a premium perspective. Now, I said earlier, we went over the kind of the two buckets, property and liability. Property, the things that they're looking at is the age of construction, the type of construction. Is it wood frame? Is it joisted masonry? Joisted masonry is wood trusses and concrete or block walls. Is it masonry non-combustible, where it's concrete or block walls, but the roofing is made out of metal? And the last is non-combustible, which is all just a metal building. Frame is going to be your most expensive property class, then joisted masonry, then masonry non-combustible, and then non-combustible. So when you're looking at purchasing a property, that's going to be one of the biggest driving variables, because ultimately fire is probably their biggest concern, and wood burns a lot easier than metal, and everything in between. So again, frame is the most expensive property rate. Metal, non-combustible metal is the least, but then you've got half block, half wood, and then block and metal. So it's going to get less as you go towards the outside of the farther you get away from frame construction. The number of stories, how big the building is, square footage. Is the building a lot?
I'm gonna stop 1 second, Mike.
Sure.
Guys, did you understand the differences that Mike just mentioned? Anybody didn't understand the differences that Mike just mentioned? Let's continue.
All right. Again, I'll reiterate real quick. You've got frame, which is all wood, joisted masonry, which is block and wood, masonry non-combustible, which is block frame, block walls with metal trusses and roofing, and then non-combustible, which is all metal. Most of your residential investment properties are going to be, all frame construction. We are seeing more and more metal roofs on residential dwellings, though, and that will be an underwriting consideration that leans in your favor of a lower fire premium and longevity to the roof, because metal roofs, they last lifespans 50 years. Is the property alarmed? Is there fire and burglar alarms? Is the property sprinklered? Is there a sprinkler system? A lot of the areas out here, a lot of new construction, even residentially, is required to have sprinkler systems. It does drive up the cost of construction, but from a fire perspective, that will give you a very large decrease premium if a property has a sprinkler system that's up to date, has been inspected, and is functioning properly. This next point leads into one of the questions we were talking about before, the last known updates to the roof, the plumbing, the electrical, and the heating. The answers to these questions show a couple of different things. Number one, it shows how well the property was maintained. And the older these things are, the more likely there is for there to be some sort of property claim. So the newer these are, the more favorable your pricing is going to be. And if they've all been updated, you're going to get another check mark in property maintenance that's going to go toward a more aggressively priced proposal. They will also consider purchase price in their equation, and whether or not they'll offer replacement cost or just actual cash value, because when you see a large discrepancy between the purchase price and the replacement cost, it does create a moral hazard that insurance companies try to stay away from. So a lot of times, if there's a big discrepancy between the two, they might not offer you replacement cost coverage, and you're stuck with an actual cash value policy. So again, a variable when you're looking at properties and what you're buying to consider when you're considering what you're going to buy. Is the property well maintained? If you are out of the state or out of the country, underwriters really like to see property management companies that will absolutely, lead you in the direction of a more favorable proposal and a better priced insurance policy. And then the last one is vacancy. Is the building vacant? Is it partially occupied? Is it fully occupied? The more occupants you have in there, the more favorable the pricing will be as well. Insurance companies are not a big fan of vacant properties. They'll do them, they'll write the policies, but you're going to pay a premium for it just because there's no one at the location. And if a pipe does break, it could be days before someone realizes it. That type of thing, or higher likelihood of vandalism and theft, things of that nature. Underwriting considerations from a liability perspective, they're going to look at, is it a commercial property? Is it residential? Is it mixed use? Or is it industrial? I have a real estate investor right now purchasing a 60,000 square foot facility, and there are high hazard tenants in it. He had a $20,000 budget for this building for insurance for the property and liability. The best option I could come back with after checking 34 companies was $32,000. The reason why, he has a tenant that has a collision shop that does spray painting of vehicles. And paint fumes are a high hazard. He has a crime scene cleanup company that is in there that has, they go in and they clean crime scenes up, and then they got to bring everything back, and there's a toxic waste disposal site in the facility. They also had one other high hazard tenant, but those are variables that when you're looking at purchasing the building, you might not be thinking about, which I suggest you really try and do, because these are things that are going to drive up the cost of your insurance that might make that profit and loss sheet look a lot different, on the other side. Residentially, underwriters really like to see two forms of egress if it's an apartment building, so that there's two exits from every apartment to increase the likelihood that if there is a fire, that they can get out. So whether it's through a fire escape, a window to another, rooftop building, but basically two forms of egress is the most favorable. And then safety mechanisms such as carbon monoxide detectors, smoke detectors, preferably hardwired rather than just battery. Outside of CO and carbon monoxide, fire extinguishers that are inspected annually, and the fire department or the fire inspector has gone through and made sure that they are there. Exit signs, lighted exit signs for the entrance and exits of the building. They were going to look to make sure when they inspect that the walkways, steps, and handrails are all in good conditions, because it's going back to the liability. That's probably the highest percentage of liability claims arise out of slips and falls that usually stem from one of those items right there. A vacancy is again from liability, because again, if the property is not occupied, it's less likely that it's being maintained as well, which is why they also like to see the property management companies in place. It's assurance for them that the property is being looked at and cared for. The last thing under the liability section is the property under construction or under renovations. Bringing in a contractor to do renovations brings on a whole new gamut of liability exposures, because there's things happen when people are working on buildings. There's tools and equipment and stuff around the facility, around the location that normally wouldn't be. And you're bringing a third party into the formula where a liability claim can occur, and now they're in a legal battle with another party. So these are all things that I when I look at buying a piece of property, that I would definitely recommend you take into consideration, because they're all things that are going to ultimately impact eligibility and the premium that you'll be paying for that policy.
If I can ask, during renovation, don't you have the liability insurance of your contractor in place that protects you from all those? Do you really need to change your policy as well at the same time?
You absolutely should. That doesn't necessarily mean that everyone does. So yes, if you're doing things with proper risk transfer in place, then yes, you will have the contractor will be providing you with a certificate of insurance. And this goes into the next slide that I have, and if you go down to look at the proper risk transfer, any contractor or subcontractor that you have working on site, you need to require that they have a certificate of insurance that shows liability, work comp, potentially, or preferably an umbrella policy for extra liability insurance. They're naming you or your entity, whoever owns the property or it's deeded to, as an additional insured. And you should also have what's called a hold harmless agreement, an indemnification clause that protects you and is in your favor in the event a claim arises, whether it's property or liability, out of the work that they're doing at your location. Now, even though let's say you do all of that risk transfer properly and you've crossed your T's and dotted your I's, the underwriter that's looking at the eligibility and insurance costs, that's coming up with the proposal for your policy, is absolutely going to use the fact that the property is under renovation in a consideration of their costs. Because even though you may have done all the risk transfer, when a lawsuit occurs, someone has to pay the attorney, and the insurance company is the one paying your attorney. So just even though you've done the risk transfer, there's a higher risk for something to occur. And yes, the risk transfer has taken place, but they still have to get involved and defend themselves and defend you in a court of law, which costs thousands, sometimes tens of thousands of dollars. So they want to see the proper risk transfer, but they're going to put it as a consideration in the underwriting and pricing of your base policy.
Can I ask a question?
Yeah.
If I buy a vacant property, I need to renovate for a month, and then it's going to be managed by a management company that's going to put tenants in there, maybe a month and a half later. how should I do all of that from the beginning? How much it's vacant, under renovation, and then with somebody inside. So how do you do all of that up front?
So what you just described is basically the premise of this next slide, this slide here that you have up. Buildings under renovation and construction, the way the insurance company looks at it, light renovations are mainly aesthetics, nothing structural like roofing, stuff like that. It's painting, carpeting, flooring, things like that. When that's the case and the work's going to be done inside of typically a 60-day window, I do not have a hard time at all getting an underwriter to insure the property on a standard landlord policy. If there's major renovations, bigger rehabs, anything structural, or if it's going to exceed 45 to 60 days, then what we will have to do is most likely write it on what's called a builder's risk policy. They're policies that are made for, buildings under construction or renovation. It's a different policy form, and we write two separate policies, a builder's risk for property and then a liability for you as the property owner. And you should still, regardless, get the risk transfer outline that I went through a minute ago that you'll see on this slide here. So no matter what, you have to do the risk transfer. It's just a matter of whether or not we're writing it on a standard policy at the time of purchase and closing, or if we're writing it on a builder's risk / liability policy for the owner of the property policy, and then converting it once it's leased and rented and being used for an investment property. Does that make sense?
Do you have to have the contractor working there give you some sort of specific form, or how did you call it? It's like a standard form?
So when you write a standard form policy, it's on the slide that I just pulled back up. It's going to be on a basic, broad, or special. If it's under renovation, they're most likely going to write a broad form policy. So you'll get a lot of.
I'm talking about the area where when I have a contractor working. I have a contractor working, and I need he needs to give me something to harmless something.
So yes.
That again.
So you want to get a certificate of insurance from anyone that's working on the property. And let me back up and say, you should have this, you should require this risk transfer, not only for when you're doing the renovation, when you purchase the property, but for any, and I say New York specific on the slide here, because New York State's labor laws are very bad, and you will lose every time in a court of law if someone gets hurt on the property, especially under renovation. But whether it's New York or outside of New York, this risk transfer still applies. You should get a certificate of insurance from the contractor that shows that they have liability, work comp, and preferably not required, an umbrella policy. Non-negotiably, they have to list your entity or you, if it's the properties in your personal name, as an additional insured on their policy for the work that they're doing. And then a hold harmless agreement, which is something you should have drawn up by your attorney. It's an indemnification clause that basically the subcontractor or the contractor signs that says they agree to hold you or your entity harmless in the event of a claim that arises out of the work that they're doing on your property.
Can I add something here? Yes, yeah. Sorry. No. I can tell you something, guys. When we bring people to service our properties, even if it's not rental, construction, like I'm talking about the plumber, I'm talking about Justin even. You guys know Justin. Obviously the roofers, everybody that comes, even if it's a rental property and they just come to service it, we ask for everybody's certificate of insurance, even if it's just a regular service. So it's much easier if there is any issue, it's much easier down the road if you have the certificate of insurance. Everybody that work on our property must provide it.
Tal, do you actually ask them even for work like a roofer's going on your roof? You ask them to be named as additionally insured?
Absolutely.
Who does that? Who comes and gives you? But if you have I just can't see contractors doing so much paperwork.
Never.
You don't do the paperwork.
They don't do. They call their broker. The broker said, "Stuff take them 5 minutes," and they have no problem. If you ask them, they have no problem with it.
It's industry standard, honestly. So our agency probably insures close to 1,000 artisan contractors, plumbers, HVAC, painters, drywallers, framers, that you name it. We electricians, we have it. It is, especially in New York State, it is standard business practice that they are not even allowed to step foot on the job site without providing the certificate of insurance with additional insured and signed to hold harmless. Now, don't get me wrong. I'm not going to sit here and say that it doesn't happen, or that that not everyone asks for this stuff. If you're asking me what the best way for you as a landlord to protect yourself from a legal battle, if someone gets hurt on your property that's working on your property, this is how you do it. It is an extra step. It is more work to do. Any reputable contractor any reputable contractor has been asked this 100 times, and it's standard business practice for them to do it. We have a lady in our office that literally all she does all day long is processes certificates for those 1,000 contractors. Because they're not, especially in New York with the labor laws and scaffold laws the way they are. The way it works, as a property owner, you are vicariously liable. So you could have this general contractor that comes to do the renovation, and he brings in a subcontractor, say a plumber, that he doesn't do the plumbing. He comes in. If him or one of his employees get hurt on your property from any type of fall of height, you are ultimately going to lose in court if you don't take these necessary steps to have a hold harmless agreement and additional insured status on the risk transfer side of things.
I totally understand, but I'm just wondering, like in my personal portfolio, I have people in and out of properties, not on a weekly basis. So for all kinds of minor work, if every time I want to get
Cheryl, you don't need it every time. Let's say you have a plumber, you tell him to send you a certificate of insurance once a year, all your LLC listed on it, and it's good for the year.
Yep.
So it's not every time, it's good for the year. Exactly like Tal said. If he's going to be there, then he's going to service multiple properties once a year. You just want to make sure that you get it at renewal. So once a year, you want to get that stuff done, and then you're good for the year with that contractor for the entire year.
And whatever he gives you, it covers his subcontractors as well, or you need the subcontractor to provide another one?
My recommendation would be to have I think you could, if you want to be super safe, to have the subcontractor sign the hold harmless as well. But at a bare minimum, the general contractor needs to sign the hold harmless with additional insured. Because I'm sorry.
So if I work with a management company and they does some repairs for me, some small rehabs or on something on a regular basis, and the management company is written as a coverage on my insurance policy, then it doesn't matter if he brings subcontractors, it's covered because he's in the insurance policy, right?
So you have a general contractor that comes and does repairs for your properties, and he brings in subcontractors. Your general contractor is providing to you a certificate of insurance that lists your entity as additional insured, correct?
No, I'm saying that if I work with a management company, and this management company, she can do some repairs on, fluent basis.
So I see what you're saying. Yeah. So the way it works, as long as the subcontractor that they're bringing in is getting paid by your property management firm, then you're fine. If you're cutting the check direct to whoever you're cutting the check to for the service, you have to have that risk transfer for. If you're paying the property management company, they should be doing their own risk transfer, but that's up to them. As long as you and the relationship between you and your property management company has that taken care of, you should be okay.
So I need to have his certificate of insurance, even though I have insurance and I put him under my insurance as well.
You need the management company to provide you their certificate of insurance. So you do, Lilach, you guys do this process of risk transfer with the management, and the management does it with the subcontractor that they bring, as long as you're paying only the management company.
Yes, I understand. Okay.
You shouldn't be, and I will tell you this, I've seen property management companies ask the landlord to provide them with a certificate and list the property manager as additional insured.
Yes, exactly.
You should not be doing that.
Why not? Because this is what they asked me to do, to add them as additional insurance, and I did that. I add them on my policy.
Well, if you request it and the insurance company does it, then they're going to do it. But you're transferring the risk the wrong way. By ultimately, in it being done like that, the property manager is being covered under your policy. Why? They're providing a service. You're paying them for a service. If they screw up or do something wrong, or someone gets hurt out of the work if the claim arises out of the work they're doing for you, that should be on them. It shouldn't go on your claims history. Now, they'll ask for it, and if they get it, that's great for them, but it's not the proper risk transfer for you. You as the building owner, you're the one, you're the one paying for the service, and in paying for the service, you should be getting protection under their insurance policy, and they should be indemnifying you if the claim arises out of work that they've done.
Okay, so I need to get a certificate of insurance and take them out of my policy.
You should ask your carrier to remove them as an additional insured, and you should be requesting them to provide you with a certificate listing you as additional insured. I was going to, the property management companies will try and do it in the reverse. You should tell them no. 100, you're taking on their risk by doing that. Additional insured means you're sharing your liability limits with whoever you list on the policy as additional insured. So let me give you the claim scenario with the way I believe you have it set up now. So you've got your entity, you're listing your property management company as an additional insured. Your property management company goes out to do work on the side of the siding of a house, and they put up, they've got scaffolding and tools and stuff, whatever they're doing, and a kid goes running by and trips on the scaffolding or trips on a piece of equipment or whatever someone does to get hurt. That person sues you and the property management company, and there's a settlement awarded of $100,000. By you listing, and the judge says, property management company, you have to pay $50,000, and your entity, the building owner, you have to pay $50,000. By you listing the property manager on your policy as additional insured, the full $100,000 comes off your policy and is on your claims record. Now, quite the reverse scenario is if they list you as additional insured, the full $100,000 would be paid for out of their policy, and you would have nothing on yours. So it's risk transfer to the party doing the work on the property.
Okay, thank you.
Yep. All right. The last one of the last slides I have here is just risk management practices. Just do your best to maintain and repair your property. Make sure the exit signs are illuminated, smoke and carbon dioxide detectors. I touched base on a lot of this. Fire extinguishers, handrails, snow removal is a big one too. If you own a property in a location where there's snow, I would highly recommend using a third-party vendor. Have them keep a log of when they salt, shovel, or plow the property. Because again, this is and ask them for certificate of insurance with additional insured, have them sign a hold harmless. This is the way you keep liability claims off of your policy, keep your premiums favorable, and transfer the risk to the people that are doing the work at your location.
So one question regarding risk management. So how many times or in which cases insurance companies can basically rescind their protection to your insurance? Meaning you file a claim and they come back and say, well, due to this and that, we find you're not liable to be coverage, to have any coverage.
Yeah, so as long as there's no clear misrepresentation on the, when there's a sizable claim, they're going to go back to an application and they're going to look at the application. The property was also most likely inspected within 60 days of binding. They're going to look at that stuff. And as long as you didn't misrepresent or the agent didn't misrepresent the account to them, and the claim, the situation that occurs triggers the policy, they're obligated to honor the claim. Now they might not, I've seen scenarios where it's happened, where claims occurred even with misrepresentation, meaning, the application doesn't match the exposure at the account, at the property. And most often the case law that I've seen, the insurance company still ends up having to pay the claim more often than not, but they're not happy about it. And therefore they will typically, non-renew the policy at the expiration date.
Mm-hmm. And what kind of cases trigger you to update your policy in order to maintain your coverage? For example, I have tenants that bought a pit bull or something of that sort. Do I need to go back and update my insurance company so the coverage for the liability will be updated that my tenants now have a dangerous dog?
Yes, I mean, the right thing, the proper thing to do is when exposures change, you are supposed to update your insurance company, your insurance agency. I know here in New York State, they actually just passed a law that, breed of dog they're no longer allowed to discriminate for breed of dog. There was a dog list in the past where certain breeds were not allowed on premises. According to New York State, they no longer do that. Many other states have followed suit since then.
So the landlord is not able to discriminate, but does the insurance company covers?
So the insurance companies are no longer allowed to discriminate as well. They are no longer allowed to make an account not eligible because you have a pit bull or a Rottweiler. What they are doing is they're limiting the amount of liability they will offer. So instead of offering that $1 million policy, they'll only do a $300,000 policy.
Okay, so you're getting screwed on the backside. Sorry.
You're getting less liability coverage, and ultimately, yes, you do have a duty to update if you have a new liability exposure. So even a tenant in the building, you bring on a new tenant, and from a commercial aspect, that's high risk. You are supposed to notify your insurance agent, who then notifies the insurance company.
Okay.
Major renovations are another thing. If you do any additions or major renovations, you want to update it as well, because that's going to help you in the renewal process, hopefully maintain more favorable renewal premiums. The last slide is just what I think an insurance agent should be doing for you. I've got contacting you at least minimum once a year to set the stage for the upcoming renewal plans. I contact all of my insureds and say, what are we doing this year? The renewal premiums typically come in about 4 to 6 weeks out from the renewal date. I wait for those to come in, and I give them a call, shoot them an email, say, this is what was last year, this is this year. From a premium perspective, these are the slight coverage changes. And I kind of open the door to a conversation as to what do we want to do this year? I've tried providing a coverage review often at least once annually to ensure the policy coverage reflects what you want and what you need. I market every account on the 4th year, no matter what. In that coverage, that renewal review appointment, yes, I'm looking at premiums from renewal and expiring, but I'm also asking the customer, were you happy with the company? Was there a claim that went bad? Is the billing okay? Are you happy with them? Sometimes the renewal conversation is everything's good. The premium's fair for the renewal. Let's renew as it is. There's no major changes. We haven't added or deleted anything. So we'll stay with the company if it's a standard 2-3% increase type thing. But I will tell you is that every 4th year, no matter what, I will market the account. And I not only say it, I will come back and show you the proposals from the companies that I've marketed the account with. And the reason why I say that is because a lot of times an agent may say that they're marketed to the account, oh, you still got the best price, let's renew it as is. They just, a lot of times they don't want to do the work, because it's extra work for an account they've already established and have on the books. So I really think it's important that at minimum every 3 to 4 years, you're looking at what other options are available to you, making sure that there's still a sharp pencil to the premium that you're paying. I would recommend that you ask them to show you the different proposals that they have. They should make recommendations to educate you on any possible changes in the market, in the industry, new products that are available, new companies that they may have taken on, and offering potential ways to save on premium, whether it's deductibles or playing with the coinsurance requirements, the valuations, the policy forms, things of that nature. And ultimately, earning your business every year, not just letting the policy go on autopilot and come in the mail, pay the bill, and be on your way. So that is all I have. I'm more than happy to answer any other additional questions.
We have, Mike, another question that came through the chat, and I'm going to translate for you. So we're going back to doing renovations and major work So assuming that all the constructor and the subcontractor all insured, and we have certificate of insured for them under the LLC. I have a certificate of insurance, and I did the harmless and all of this. So I did all this risk transfer process. I did it properly. Should I, or do you recommend that I'm going to have, just in case, some kind of additional insurance under my name to anything that's going to penetrate their insurance coverage, or I'm going too far with it?
No. So when you say in your name, do you mean,
under the LLC, itself,
under the LLC?
Yeah.
So, I mean, typically at that point, most LLCs and business investors won't have an umbrella policy in place, or, for that location, because it's a new property. If you do have an existing umbrella policy, what you should do is add that property to it, so that you have additional liability coverage above and beyond the standard policy. So, as soon as you buy that property and close on that property, you should add it. But outside of that, if you have the proper risk transfers in place and you have a standard policy in place, whether it's the builder's risk and the liability for the owner, or a standard policy because it's, the underwriter was okay with it, and the risk transfers are there, I don't really think there's anything extra and that you need to do at this time.
Okay, let's talk about something that is specifically, I don't know if it's just New York, but I know it's New York thing, which is a worker comps. Can you explain in like 2.5 sentences what is worker comps and what does it mean regarding requiring it from the your constructors?
Yep. So workers' comp is required in New York State as soon as a business owner has an employee, a W-2 employee. And it covers the employee if they get hurt on the job. Now, as the business owner, as the investor, you're bringing someone on to do work. So you have a plumber come out to do work. If it's a one-man operation, a sole proprietor, he's not required to have workers' comp. All right. New York State says he doesn't have to have it. But if you have, for example, a property manager that's bringing in the plumber, you want anyone that's stepping foot on the policy that's through that property manager to carry workers' compensation. Otherwise, it can come back to you if they get hurt on the property.
Can you give 2.5 sentences a difference between the worker comps and the liability? Because you said if somebody is hurt on the property. So a little bit the difference between the liability and the worker comps. What's the difference between them? Yeah.
So general liability insurance is covering the contractor that you have that comes onto the site to basically, if they damage your property or they cause bodily injury to one of your tenants or someone there that's around the property, it's going to cover them if they get sued for hurting someone else. By you being listed on their policy as additional insured, you're going to get named in the lawsuit. The property owner and the contractor is going to get named in a lawsuit if someone gets hurt at the property. A good lawyer in New York State sues everybody. So by you being listed as additional insured, you're protected by the contractor's liability policy, and the contractor is protected under their liability policy. The workers' comp is what covers the employee if they get hurt while they're working on that job. And if they don't have workers' comp, their attorney, the injured employee's attorney is going to sue you and sue the contractor. So if they have workers' comp, it stops their ability to actually sue the contractor. But the injured employee can still sue you as the building owner in New York, which is why it's so important to have the hold harmless agreement and the additional insured status on anyone that basically steps foot to work on your property. Does that make sense?
To me, yes. The rest, we'll guess that we are. Any more questions, guys, ladies?
Sorry, just real quick, the hold harmless is something we'd get ask for from their insurance, or it's a form we should have on hand and they sign?
It's a form that you have on hand. I mean, I have a sample hold harmless it's got a watermark on it that I can email out to. I can send it to Tal, and if you want to send it out to everyone, it'll give you an idea of what it looks like and some of the verbiage used in them. There's a watermark on it because you really should have an attorney draw it up specific to to your entity, your operation, as well as the states that you'll be working in. But it's a document that you will have in your possession that you will hand off to a contractor working on site and say, I need a certificate of insurance with additional insured from your insurance company, and I need you to sign a hold harmless agreement, while you're working for the work that you're doing on site for this job.
So definitely, Mike, email it to me, because when we're going to finish, probably the next day or two, I'm going to shoot an email to everybody with your contact information and a copy of this recording. So if you'll send it to me, I'm going to add it just so they're going to have an idea how it looks like. And again, as Mike recommended, go back to your attorney. And to the guys that don't work with attorney, I always recommend to work with an attorney. That gonna write down one that is specific for you, like I mentioned.
Yeah, the other thing, I'll include a sample certificate of insurance that's got the additional insured wording, a sample hold harmless agreement. And the other thing I'll throw out there, please feel free to use me as a resource if you have additional questions down the road. All my contact info is on the screen. If you're doing work in New York and you need contact introductions for attorneys, accounting, things like that, I'm happy to send you local people that I've worked with for years and are good at what they do.
Mike, do you do insurance in Ohio too?
We do write insurance in Ohio. We are a little bit more limited in regards to the number of carriers. I believe we have 6 or 7 carriers that we represent in Ohio, so it will limit me a little bit. Compared to a local agent that might have 30, but we do have Ohio as a state we're licensed in.
Okay, thanks.
Perfect. First of all, I would like to thanks Mike. Mike, I appreciate your time. You've been very thorough, and we appreciate it and all the knowledge. Guys, as I said, I'm going to shoot an email in a couple of days with all the materials. If you guys have any questions, you can contact Mike directly, or you can contact me, and I'm gonna put you in contact with Mike. And we always here to help.
Sounds good.
Good.
Thank you very much, guys.
Thank you.
Thank you very much. Have a great evening, Mike. Thank you. I really appreciate it.
Thank you, Mike.
Thank you.
טל, תודה רבה על הכל, טל.
Thank you, guys. Thank you.